we're going to take a look at primary transaction, really, which we've already looked at before, issuing common stock. And what about dividends? Well, dividends are distributed from retained earnings. I had that question earlier this morning, and basically it's going to come out of retained earnings. So in this case, you've got dividends. And that's coming out of retained earnings, and if it's paid, it comes out of cash. But Scott asked the question earlier today, how do I get a transaction on both sides of the liability and equity side? If you declared the dividend but didn't pay it, it's a liability. One thing you have to keep in mind, dividends are liabilities when they are declared by the board of directors. So that if I declare a dividend but don't pay it, I create a liability. In this case, we assume we're paying. Now, of course, make sure, and this is critical, and make sure that this was here, dividends are not expenses. They look like expenses. They have the same effect on earned capital. They are not expenses. They are distributions out of retained earnings. And you may not even say it's a distribution of current year's profit. Could you declare a dividend if you have a net loss for the year? Yes. You're paying dividends out of accumulated earnings, not necessarily this year's net income. So dividends are distributed from accumulated earnings, not necessarily the current year's profit or loss. So again, it is not an expense. It uses cash. What is the classification of a dividend? Operating, investing, or financing? Well, let's think about it. You're paying dividends to whom? Stockholders. Stockholders. Stockholders gave you money, provided you with financing. So it's a financing activity. It's a financing cash flow. So dividends are considered financing cash outflows. Financing cash outflows. Okay. Now, just one last point on the balance sheet. This is the full balance sheet for all this entire example. When you look at the stockholders' equity section of the balance sheet, you notice that it is 660, and retained earnings, I should say, and retained earnings, of course, in this case, the only retained earnings we had, we started with 0. Now we had net income minus dividends, and that's how we get the 660 as the balance. The retained earnings is going to be coming from, and the changes in the balance sheet. Remember, the balance sheet is a static statement, a snapshot, as you said. And how did it change? Well, it changes through earnings, and it changes through investments, and it changes through dividends. So the stockholders' equity statement is another financial statement. Back when I first learned accounting, they told us that there were 3 financial statements: income statement, balance sheet, and there wasn't a cash flow statement back then, a funds flow statement they called it, but there were 3 statements. The stockholders' equity statement was never considered a major financial statement, mainly because it simply summarizes the changes in capital. But today it becomes a major financial statement. So the name of the company, title of the statement, and it says for the month ended. So is that a flow or a static statement? For the month ended. How would you classify it? It's flow. It's showing you the changes in stockholders' equity. So if you have any statement that's a reconciliation of beginning and ending balances, any statement that's showing you changes, this is a flow statement. So now, if I went back to the balance sheet, let me do that right now. I go back to the balance sheet. We're gonna be showing a lot of these numbers as we move along. By the way, lots of the homework, which kind of makes you crazy in the beginning because they ask you to kind of back into lots of numbers. And accountants don't generally like you to back into numbers because they want to say, how'd you get that number? Well, I just backed it. No, you got to show me some evidence. But from the standpoint of understanding what's going on, if you want to understand how the statements were changing, you may be able to start maneuvering around a little bit. So I need to know, for example, at some point how cash changed. We'll get to that. But right now, how did equity change? Well, I had investments of $10,000. I had no beginning balance of retained earnings. It's my first year in business, but I was able to earn $1,060. I paid out dividends of $400. So I've got a balance of $660 in retained earnings, and my total equity is $10,660. Total equity is $10,660, and of course, that's what you see here. So the balance sheet is going to articulate with a statement of stockholders' equity. So the way, and when we look at the statement preparation, and I know we said this before, and I know you've been working with this on the homework, the statements are going to be, if you had to look at the flow of statement preparation, you're going to do the income statement first, then the statement of stockholders' equity, then we have the balance sheet, and that's going to be what we're going to be doing for most of the semester except for the last week. And then we'll get, I'm saving cash flow for last. So what we know so far is that in order to get the statement of equity, we need the net income to be determined first. That net income is then used to prepare the statement of stockholders' equity. The balance of the statement of stockholders' equity, the 1066 there, or 10660, goes on the balance sheet. And 4, we do the cash flow statement, and we need everything for the cash flow statement. So we always prepare income statement first, statement of equity, balance sheet, and then the statement of cash flows. All right, so very quick learning objective. Do you have any questions on the statement? Again, it's a flow statement designed to explain or reconcile the changes in stockholders' equity accounts. Yeah.
So when does this statement get complicated? Is that when they start issuing more shares to maybe buy another company? Or?
Yeah, I mean, there's a lot of things that can happen in the equity section. Generally, it's not all that active, so that you do see treasury stock transactions. So if you go on an internship, you'll see mostly treasury stock transactions, dividends, stock options, employee purchases of shares. You don't generally see as many new issues as you would think. There's always an initial public offering, and then that's probably about it. Sometimes a secondary offering, very close to the IPO, but you don't see much after that. So the activity in capital stock is really going to move with the treasury stock transactions and dividends, and of course net income.
So basically, I'm not going to say it's static like a balance sheet, but it's not like an income statement where you can be updating that.
Yeah. Right, it's that's why the statement of equity was never really looked at. In fact, when you audit, it's a very quick, it's a quick learning objective. It's a quick part of the audit too. You just have to work with transfer agents, registrar. You have to work with the movement of some of the shares, particularly the treasury shares. But it's a very it's significant, but not as significant in terms of changes as the income statement.